Good morning, everyone. Welcome to the pre-market stream. It is Wednesday, August 12th, 2026. This morning we had CPI, and we are currently up about 0.5% per SPY. A couple of things with the data. I'm not too surprised the data came in at what it did. As Mike had mentioned, it's been pretty on par with expectations during Trump's administration so far. Here's the other thing. Yesterday, one of the big things that we did do is yesterday we did finally get algo succession. So you guys will see it broke the streak that we had, which is 3 days of no algo succession. So the official start date for quantitative exhaustion is the 10th, Monday the 10th. That's day 0. So day 1 would have been yesterday, Tuesday. Okay, that's what kicks us off. So what we first need is day 5. Okay, this is the 5-day pivot, which would be Monday. We'll call this the day 5 pivot. And I'm going through this with you guys on the spreadsheet just to show you the process here. We're going to do this every single time we get quantitative exhaustion. So I'm just going to highlight this here just to show what we got on the agenda here for us. And maybe I'll do something like this. Day 5 pivot, 6, 7, 8. Day 8 is our validation date. All right. That is Thursday, August 20th. The day 5 pivot is the biggest reversal risk in the initial trend following quantitative exhaustion. So right now, guys, how we close today is going to impact the initial trend of this move. And then timeline wise, day 4 through 6. Okay, so day 4 through 6, timeline wise, is going to be where we have the biggest reversal risk. And we will use the high or the low of day 4 through 6 as our benchmark to determine if we're going to continue the trend or if we're going to reverse and come back to this lovely level here, which is the validation level. In this case, it's the close. It's the market close from Monday. I'm going to just double check this here. The close says 773.03 on the daily chart. It's kind of odd because on the 5-minute chart, it actually looks like it's higher. Yeah, it's 06. We're going to go off the daily candle because that's what we've done consistently. By the way, quite the knife to start us off today. Let's talk about this here. What do we have on the VIX? This kind of paints a picture for the type of day. Okay, so VIX pre-market range is 48 cents. Why does that matter to start the day? Well, our sweet spot for volatility is between 33 cents and 88 cents. That's where all of the biggest and most explosive moves happen for the biggest days of volatility, but also our bullish trend days. So there is no bias regarding the pre-market range. What we do know is all of the biggest trend days to the downside at the initial start of the quantitative exhaustion cycle do happen when VIX's pre-market range is 33 cents to 88 cents. Okay, so there is no particular bias towards that. It is a trend-based range more than anything. You can have really good trend to the upside with that range, but what we do know is all the biggest moves for volatility, all the biggest moves for the VIX have occurred between that range in the beginning of the cycle, right? So we're talking about timing the top of the market. Okay, not when you're in the middle of the correction, not when you're towards the end of the correction. When you're in the middle of the correction and the end of the correction, this range is going to be drastically different. It's what we're trying to identify is the top. Okay, so as far as tops go for the market, that the sweet spot is 33 cents to 88 cents. So there is that risk today that can happen, but it doesn't mean we have to do that. We can certainly do a trend day to the upside if we wanted to and keep the grind. Now, one thing to keep in mind regarding the grind is, let's just zoom out in the big picture here. Let's go to SPY. So in the big picture, this is the daily chart on SPY. All we really need to focus on right now in the next couple days is where do we end up by day 4, 5, or 6? Okay, if we start gravitating towards the upside up here, there is a chance we end up topping out and being pulled back to this anchor, the validation level. Okay, so the validation level, which is 773.03, that's what's going to pull the market as we get away from that level. So why does this level matter here? Every single year, we know that we get about 26% in corrections total from quantitative exhaustion. What we also know is we do average about one quantitative exhaustion alert per month. It's about 11 or 12 per year. Out of the 12, we're looking at anywhere from 2 to 4 correction cycles that actually complete per year. So far this year, we've completed 2. We completed the most recent one back in June and July. And then we completed the one back in March. That's 2 cycles totaling about 15.5% in corrections. We have about 10 to 11% in corrections left for the year to hit our annual average. And we could see either one big 10% correction, or we could see 2 5% corrections. Could we see 3 corrections? We could, but statistically improbable to have 5 different completed cycles. We're looking at 2 to 4 per year. So if we were to do one right now, this would be the third one, and it would only be 2.36%. We would still need about 7.8% in corrections after that. So what do we do with that information? As far as executable trades, here's what I would like to see, because personally, a 2.36% correction is stupid. Why is it stupid? It's not a real correction. And actually, a 2.36% correction falls in line with the invalidation setup for all of these alerts. The invalidation setup, there's 3 setups for this entire thing. 3 things. We'll just dumb it down and simplify it here. Predicted bottom long, VIX TP1 rejection long. That's a long on SPY. All of these are longs on SPY. And then SPY invalidation long. So what is all of these? Predicted bottom long is simple. We just did that back in July. We did that back in March. VIX TP1 rejection is where SPY doesn't quite hit the predicted bottom, but VIX actually goes to TP1 and rejects it and it's an early recovery process. Once TP1 gets rejected on the VIX, SPY doesn't hit the bottom, you go long on SPY. Or the third one is when after this validation date, which is Thursday, August 20th, you can see here by this blue vertical line over here. Once we get past that invalidation date, here's the box. If you close above this validation level after this date, you're looking for a long setup. If you close below this level after this date, you have your downside risk all the way down to the predicted bottoms or VIX TP1. So it's an if-then scenario, and what happens between now and then doesn't really matter. We can day trade it if we want, but what we do know about this particular time period right here, is typically this becomes an anchor around one level. And that level is your validation level. So wherever we end up going, no matter how high, no matter how low, the timing of any reversal back towards this validation level, if there is one, happens at the 5-day pivot, which in this case is Monday the 17th, between day 4 and day 6. Okay, day 5 is that sweet spot, but day 4 and day 6, we will potentially bottom out and then go back towards the validation level leading into this validation date on Thursday the 20th. So that's what we're prepping for right now. We're prepping to follow a trend and then eventually and potentially end up at that validation level as its anchor going into the validation date. This is very common for the market to do this during these corrections. Honestly, the last time we did not do this type of thing here, where we just dropped and we went straight down and just kept going down and never checked back at the validation level, was the tariffs. It was the tariff correction. Prior to the tariff correction, we've done this right here, what I've drawn out. Okay, so this black box, these black arrows, shows the all too common behavior of the S&P during these cycles. Now, if we're going to invalidate, let's say we're going to validate 2 to 4 out of the 12 cycles per year, well, you're looking at 1/6, so less than 20%, and upwards of 33% of all of these cycles per year. So you're looking at about 15 to 30% that these exhaustion alerts actually become a full-blown correction. I just want you to keep that in mind. There's 2 to 4 that pan out every year. There's a roughly 11 to 12 that occur every year. So you're looking at 15 to 33% of the time we're actually finding the predicted bottom. Why do I bring this up? Because a lot of people are going to be tempted to short. I know it. There's people seething at the mouths about being the best short caller in here. That's not the purpose of quantitative exhaustion. The entire purpose of quantitative exhaustion is to go long, and it's off of one of these 3 things right here. This is what I want you to focus on. What's our objective? This is our mission right here. We want the predicted bottom long or VIX TP1 rejection, which is also a SPY long, or the SPY invalidation long. Now, why did I say the 2.36% correction is stupid? Because I did make that statement earlier. Why is it stupid to me? because for the invalidation long, enter off 2 to 3% off highs. You see that? So in this case, I have a predicted bottom of 2.36. Well, look at SPY invalidation. The entry off the SPY invalidation long is basically 2 to 3% off highs off of a bear threshold, which is another indicator I use for reversals. So this 2 to 3%, 2.36% projection, which is what the data says, I think is stupid. It doesn't do anything as far as the 26% performance on an annual basis, right? It takes us from 15.5% in corrections to, about 18%. So we're still looking at about 8% that we need in corrections for the year. So it really doesn't do much for me. So could we do that? Sure. But if we do that, then we're going to use the 236 and we'll never be able to use it again. I personally don't think the market's going to do that. I think we're going to invalidate. Here's why. This year we've been using daily range triples as cumulative sums for projection targets on our corrections. So if I lose this 236 by satisfying the predicted bottom down to 758, then what does that mean for the future if we're going to do cumulative sums? It means I have to have 2 other sets of daily range triples. You know how much that takes a lot of work for the market to do the exact same range 3 days in a row. That's a lot of work. That's a lot of algos, a lot of manipulation, and it requires time. What if the market doesn't have the luxury of time to do that? And what if the salient characteristic of this year, which has been cumulative sums to hit our predicted bottoms, can't afford that amount of time right now going into the fall? So my thought process here with all of this is that I think we can still correct to this 2.36%, fill this gap on SPY from August 3rd, and achieve new all-time highs without actually hitting the predicted bottom, but instead, through this process, invalidate the setup by closing above the validation level, which is 773, on or after the validation date of August 20th. So we could still check back. So let's say August 20th, we close above this level. Well, we would invalidate the correction cycle, the current cycle. It would be thrown out. And then what we're doing is we're going to SPY and we're looking for 2 to 3% and 4-hour bear thresholds. And then we go long off of those. And then we go to new all-time highs and we start the process over again. So, and the benefit of doing that would be this. We would not use this 236 triple. We could actually store that for later, for when we get another triple, and then we get another set of quantitative exhaustion. Then we could have a bigger correction, like 5%. Let's say we get another 236 triple. Well, then we're looking at 4.72%, just like we did this summer. It would be the same correction target if we got another 236 triple. And that also increases if we get a higher triple than that, which is fine. We could get a 786 triple, add the 236, and before you know it, we're at 10%. And we're pretty much at the 26% in corrections for the year. But as I stated many days ago, I don't think a 10% correction would occur off of 776 as the high. I believe that would occur off 825 or 826. That is the final target on the long-term harmonic dating back to 2022. So you'll see up here, 825.88 is that long-term target. If we go to the weekly chart here, here it is. That's where I think we'll get a 10%. If we do a 10%, because there's 5. Where does 10 bring us? Right in the middle of 744. That takes us from our first target, 744, from our third target. So if we do a 10% correction in the future, 825 or 826 makes way more sense. Whereas if we do it right here, we're kind of in a sticky situation because now we're retesting the highs from January, which means what? We're wiping out annual gains and then begging for mercy on a bounce to get the S&P at what? I don't know. 5%, up 5% on the year. I don't think that's going to happen this year. So personally, instead of a 10% correction, I think if we do a 10% correction, we do it in the beginning of next year. 10% or more in the beginning of next year. For now, I think we utilize smaller corrections, like 5% or 6%, to get us there. From a statistical standpoint, we have up to 2 more corrections that we could accomplish to get us our 10 to 11%. We could get 2 5%, we could get a 6% and a 5%. And the way things are going right here, if we can, I mean, if we wanted to, could we do this 236? Sure. We could. But it really wouldn't accomplish much down here at 750. It just wouldn't accomplish much. So let's play devil's advocate to this really quick. What if we do something bigger? Right? I've been seeing charts of 720s to 710s again. And everyone's looking at this and saying, yeah, we could do this big old head and shoulders setup, and we're going to go, retest the neckline and then end the year like this. Could we do that? Yeah, we could. I just don't think that's going to happen. I don't think they're going to wipe all this out here right now. I think they will eventually. I think this will get wiped out pretty good, but I don't think it's going to be this year. Could they try to do it going into midterms? They could, but I don't think they're going to actually accomplish it. I think shorts will get blown out if they try to do that. Right now, they're seething at the mouth. We're going into September. Everyone's getting hedged up. It's attractive to hedge right now. And you got midterms, so you got September being the worst month. October, cyclically, we tend to go down prior to the big earnings at the end of October and early November. So that's another thing that causes people to seethe at the mouth. Then we got midterms in November. That's another thing that would cause people to seethe at the mouth. And personally, I think they're going to do everything to destroy everyone's seething at the mouth, and I think it's going to result in what I've labeled the denial rally. Everyone who is bearish, I think, is going to get hurt really, really bad. So bad that they're just going to say, screw it, I'm bullish. And by the time they're bullish into 2027, we'll get the 20% correction. I look at like Berkshire Hathaway right now deploying their cash, and I'm like, okay, really? Now you're deploying the cash? Yeah. So all in all here, what we are waiting for in the short term is day 4 through 6. We're waiting for Friday this week through Tuesday of next week to determine whatever the high or low is in the current trend. And then we can play an if-then statement off that. Okay? We could look at a trade for that. Right now is not smart. Okay, do you guys remember the 236 algo succession? So the 236 algo succession is affiliated with range and consolidation. Look at what they're doing to VIX right now. They are dumping VIX. What are they doing to SPY? Nothing. Nothing. Okay? You want to talk about manipulation? Yeah. Everyone's seeing VIX right now and they're like, yeah, okay. So maybe I should buy some calls. Why is the market not going up? So we got SPY and VIX going in the same direction. What about oil? Oil's coming down. VIX is going down, oil's going down, but SPY's also going down. Look at SMH. Look at all the sectors right now. All of them are below their opening price. Qs are down almost 0.5% below open. XLK down half. So tech is down half. Semis is down half. Communications is down 0.75%. Consumer discretionary is down almost 1%. Guys, VIX is falling, but our sectors are rotating out. Make it make sense. SPY is falling with VIX. We have quantitative exhaustion. That's what we know. We've got that in our holster right now. So, big picture wise, just pay attention to what these sectors start doing, right? Because we know SPY's the last one to go. So these next 3 days, 3 to 4 days, let SPY cook. SPY is going to cook, but watch these other sectors the next few days. Especially if you start seeing these ones right here, discretionary, communications, financials, tech, semis, you start seeing those rotate out, but SPY is still, above 770. Yeah, that's because SPY is the last one to go. And historically speaking, the day 5 pivot exists because of this phenomenon. Because SPY tends to grind. And then if it does pivot, it does it off this time frame between 4 and 6 days after the quantitative exhaustion. Then you get stuff that's pretty interesting. Okay, so ultimately, we're just going to accept what the market does for us. So if it does bring us to the predicted bottom on SPY, we're going to buy. But my gut my gut is telling me it's going to save this data point, which is the 236 triple, and it's going to use that for later and do a bigger correction later, meaning SPY's going to go up first, and then it'll do a bigger correction later. Bigger meaning 5%, 6%, and maybe do that twice. I'd even like to see overlapping corrections. So for instance, if we do invalidate, so check this out. If we do invalidate this correction, and in the future we get a triple, and then in the future we also get two sets of quantitative exhaustion. So let's say 2 quantitative exhaustion alerts. How would I apply what we have here in the data set? Okay, so if I get, let's say next week we get 236 3 days in a row, and I have another triple, and I'm going to highlight this as purple. The things I'm going to use are going to be purple here. So let's say I use 236 plus 236. That gets us 4.72, which is roughly 5%. We hit a bottom, and the market does something like this. So there's the first bottom, and then we go a little bit lower for the second bottom, and then we make new all-time highs. Why do I have this double bottom drawn? Okay, so let's say 5% is this. This is hypothetical right now. Let's say we satisfy the triple with a 5% correction, but we also have a second set of quantitative exhaustion. What would we use now that these two triples are expired? I would have to use the highest pair or triple prior to that. So the highest pair would be 618. So then 618 would be applied to the second bottom, which would be this one right here. So it'd be a 5% bounce and then 6% off of the highs here. When else did this occur? This occurred at the end of 2024. Here it is. Let's go back in time here. Here's the first one. See this? And then the second one right here. And once both of them were satisfied, new all-time highs. Now that's a 5% correction plus another 5% correction. That adds up in 10% in corrections from quantitative exhaustion. So if we were to do this in the future here, let's say we avoid this current correction altogether. We bank the 236 triple to use later. We end up with a 236 triple again. We get two sets of quantitative exhaustion overlapping. Well, then this is what we get. We get a double bottom structure, 5 and 6%, or 5 and 5%, adding up to 10 or 11%, which satisfies the 26% in annual corrections, which is our average, which also satisfies the 2 to 4 quantitative exhaustion cycles that come to fruition every single year, 2 to 4 out of about 11 or 12 that get alerted. All of those things get satisfied by this happening. So as much as it would be cool to see another predicted bottom, you guys, I actually think it would be cooler if we saw invalidation and we grind it higher. And then we get another triple in the data set. And then we see an overlapping setup. Now, let's say that we we don't get 2 overlapping setups this fall, but instead we get a triple that says, 786 instead of 236. So here's the other scenario where we would do like a big correction. So let's say it's 786 plus 236. That's 9.86. So it's about 10.22 is what that is. That's 10.22%. If we had 886, a triple 886, it would be 11.22%. So let's say that in the future, instead of a 5%, 2 5%ers like this for a double bottom structure to take us higher, instead we do something else. We do just one big 10 to 11% correction. Well, how would I like to do that? Well, number one, we could head towards the final target, 826. And then let's do a little measurement. By the way, why 826? For those that forgot, it's the final target on the harmonic. I had 3 targets, 744, 776, and 825.88 for this year. We've hit 2 out of 3 so far. So here's the correction. Remember this, if we got a triple 886 or triple 786, and we follow the pattern from this year where we have cumulative sums for our corrections, then we end up with either 10.22 or 11.22%. So 10.22 from 826 is 741.65. Let's do this again. 741.65, about right here. Okay, where does that take us to? Right back to 744, the great anchor that we had, the midpoint from the last few months. A really good place to stop, right? Very good place to kind of hit the reset button. 11.22% would be a little bit further. About 733. About right there. We'll just make this dashed. All right, simple enough. This is what we could do. If we're not going to do, overlapping type stuff, and we're just going to do this, it'll be a sharper correction, similar to the spring. Hopefully it's not as long-lived. Hopefully it's way faster, right? We could get a Japan yen carry trade type 10% correction, which is what happened here. Okay, much faster. It accomplished in 19 trading days to the T, and then guess what? We had a V-shaped recovery. Like that. That's the type of 10% correction I would like if we did that. Otherwise, if we don't get the V-shaped 10%, I want to see a double bottom 5% or 6%. Overlapping 5 and 6. So this is what I'm looking for here. Either way, I do want to go higher. I want to avoid a 236 correction right now because it's not a correction. It's nothing. It's nothing but a fart hiccup. So the current numbers that we have for 2.36% just doesn't make sense. It's a waste It's a complete waste of an exhaustion cycle. It's a complete waste of this data of 3 days in a row of 236 for the market to do that. I don't think the market's going to do that and waste this triple. After all, this year, the triples are what have led to the cumulative sums for our corrections and for our bottoms. I don't think the market's going to waste it. I think it's going to put it to use. And so that's why I'm leaning towards, we're going to stay sideways a little bit. We're going to invalidate. We're going to punch higher. We'll head up towards 825, and then things will get spicy. Then we get either 2, 5, or 6% corrections with a double bottom structure or this V-shape type recovery. So I'm basically just going to redraw this here to show you the two scenarios that I want. Either this one, this is the 10%er, or let me look for 5 and 6%. So 5 is about 784, and this is assuming we hit 825. 784, and then 774. Bounce. And then new all-time highs. I'll make that blue. So this is what I want based on what we have in the data. And this is also what makes the most sense based on the behavior of the S&P. So if I'm just throwing all of my bias out the window and I'm just looking at this, it's kind of like anyone who has a kid, right? You know how your kid's going to behave. You know what your kid's like better than anyone. All right. So I'm looking at my own system here, and I'm looking at this and I'm saying, I know how my system behaves. I know how this S&P behaves. And based on what we have in the data set, it just makes zero sense to do this, to do a stupid 2.36% correction. To use that important and useful data set and then have to do it all over to work extra hard to get more data points in the future. So yeah, that's kind of how I'm seeing this on the S&P. Is although we have quantitative exhaustion, I am skeptical about it following through. Now let's talk about the one scenario that I did draw out, which is, give me a second here. All right, we'll turn this off. Okay. So the second scenario, okay, this is the one where we get a predicted bottom, a second predicted bottom target of 8.54%. This is the wild card setup. I don't like this because there's nothing to support that this would happen because it hasn't happened yet. And what is this structurally? This 8.54% is saying, okay, we have a 236 triple. Because this year we've utilized cumulative triples to find our bottoms. So the most recent one was 236 plus 236. That got us this target back here. See if I can find this. In June, yep, down here, 4.72%. That's where that came from, the 236 cumulative. And then prior to that, in 2025, we had two triples. One was a 0.707 and another one was a 0.382, and that gave us our bottom in March. Okay, down here. So the wild card I'm throwing out is because we don't have two triples at the moment. We only have one triple. We got a bunch of doubles. So the wild card I'm throwing out is, well, what if the market does a cumulative target, but it only utilizes the 236 triple we have, but then it also utilizes the 618, which is the highest double. I have not seen that type of behavior yet. But what if? Okay, so that's what this second set down here at 710, that's what that second set is. It's 2.36% plus 6.18%. Now, what I'm doing is I'm anticipating a change in behavior of the market. I don't like anticipating that, but I'd rather be prepared for that type of odd measure to occur. I don't think that's going to occur. I don't think any of these will occur personally. That's what my bias says. My bias says we're going to save the 236 triple. We're going to invalidate the correction. We will head to new all-time highs. We will project as high as 825 or 826. And then we will do either a single 10% correction or two 5% corrections. Now, another thing that can happen is, let's say that we don't go to 825 to do two 5% corrections or 10% correction. Maybe we go to a psychological level like 800 and we do a 5% correction off 800 and satisfy the gap fill down to August 3rd, which is about a 5% correction. So off of 800 is about a 5% correction. So could we do that? Or better yet, could we go to 800? And I might even like this better. Could we go to 800 and do two 5% or 6% corrections? Filling the gap, and then have time into the end of the year to head towards new all-time highs and to head towards my final target of 825.88, which is basically 826. And then in the new year, we do the big correction. We do a 10% or we do a 20%, depending on what the quantitative data shows. I like that as well, right? So let's say that we invalidate the current setup. We bank that 236 for the future. We move all the way to 800, a psychological level. We initiate a 5 or 6% correction, and perhaps that correction is overlapped. We could have two separate corrections based on the data we have right here. So we could do a 236 plus 236, which is 4.72, which would get us pretty close to 760. So it'd be like 760. And then if we satisfy the 236 triples, then we would have to pull from the highest doubles we have for the second target. In this case, it would be 618. So 618 from 800 is about 750. So all we're talking about is a lower low double bottom structure. 760, bounce, 750, boom, new all-time highs, November, December, close the year out above 800, leave a little bit of meat on the bone to 825, And then in January, we head over to 825, and then we get quantitative exhaustion, and then we get a 10 to 20% correction in the spring. I like that a lot better. So now I'm going to take a little break from this here. I'm going to switch over the chart for SPY. I'm going to answer some questions, and I'm going to post this part of the stream into the recorded streams here now before I get too carried away. So thanks for your patience. If you guys were asking questions, I just wanted to get through my thought process there.